Look at a world map. Find the Persian Gulf. You will see a tiny sliver of water connecting it to the open ocean. This is the Strait of Hormuz. It looks like a minor detail, almost insignificant. A simple line drawn between Iran and Oman. But this thin line holds the global economy in its grip. It is a geographic funnel, a bottleneck for the world's energy supply. What happens in this narrow passage can dictate the price you pay for gasoline. It can rattle stock markets and start recessions. This essay explores a powerful idea. It is the idea that Iran could monetize this control without firing a single shot, potentially earning billions. The power of this waterway is not in its size. It is in its location, and liquefied natural gas must pass through it. They leave the massive fields of Saudi Arabia, Kuwait, Qatar, the UAE. They are heading for the energy-hungry markets of Asia, Europe, North America. The strait is only 21 miles wide at its narrowest point. This makes it one of the most strategic choke points on the planet. Its small size makes it easy to monitor and, potentially, to control. The question is no longer if it can be controlled, but how that control could be turned into cash. Imagine a single gatekeeper on the world's most important energy highway. This is the power Iran holds. The country's long coastline dominates the northern edge of the strait. Its naval forces can reach any ship passing through. For decades, the world has worried about Iran closing the strait. That would be an act of war, a dramatic and costly move. But there is a subtler, more lucrative strategy. It is not about closure. It is about control. It is about charging a fee for safe passage, turning a strategic asset into a massive source of revenue, year after year. This idea is moving from theory to reality. Recent events have shown the first steps of this monetization plan. The world is just now waking up to the implications. The concept is simple and powerful. Turn the Strait of Hormuz into a toll road for oil tankers. Instead of closing the gate, Iran could simply charge an entrance fee. It's a model we see every day. Drivers use a FASTag or an EZ Pass to pay for using highways and bridges automatically. The same logic can apply to the sea. FASTag for tankers. A tanker transmits data and receives a clearance code for a fee. A ship wishing to pass through the strait would need to obtain a clearance code. To get that code, it would pay a toll. This toll could be a flat fee per ship or a variable charge based on the volume of cargo, like $1 for every barrel of oil. This is not speculation. The first signs of this system are already in place. According to recent reports, Iran is already charging some tankers up to $2 million per voyage. This is not a random act of piracy. It is becoming a formalized process. Iranian lawmaker Alaeddin Borojerdi has framed it as a reflection of Iran's strength. He and other officials have said that Iran must collect fees to ensure the security of ships passing through. The country's Islamic Revolutionary Guard Corps has reportedly set up a documented procedure for this, creating a de facto toll booth system run by military intermediaries. Ship operators must now contact IRGC-linked agents. They submit their vessel's documentation, including its unique IMO number, a full cargo manifest, the names of the crew, and the ship's final destination. Once the information is verified and the fee is paid, the vessel receives a clearance code and specific route instructions for its transit. Let's break down the numbers to see how quickly they can add up. The math starts with a single ship. The average supertanker of VLCC holds about 2 million barrels. If Iran imposed a modest toll of $1 per barrel, $1 x $2,000 barrels. Wide are $2,000 per tanker. One ship, one trip, $2 million. This matches the upper range of reported figures. Scale up to a single day. About 110 vessels transited daily. About 20 of those are major oil tankers. Focus on the oil. If 20 million barrels pass in a day, 20,000 x $1 is $20,000 per day, every single day. Even with lower traffic, the totals stay large. Just 5 supertankers paying the toll would yield $10 million in a day. Now look at annual potential. $20,000 per day, x 365 days, for $7.3 billion per year. That's from $1 per barrel at pre-crisis traffic, a big boost to Iran's sanctioned economy, a steady stream of hard currency bypassing restrictions, likely collected via intermediaries, hard to trace or stop. This estimate is conservative. But what if the toll were higher? $2 per barrel would double annual revenue to nearly $15 billion. Charging a premium per ship on specific voyages could push totals higher. The numbers can escalate quickly. This isn't a few million, it's tens of billions annually, reshaping Iran's economic and strategic position without firing a shot. The ultimate revenue depends entirely on how aggressively Iran pursues this strategy and how the world responds. We can outline 4 potential scenarios, ranging from conservative to full control. Each scenario is a framework, not a precise forecast. It illustrates the massive financial stakes. These are broad estimates based on traffic levels, fee structures, and international compliance. The range of outcomes is wide, highlighting uncertainty and volatility. First, a conservative scenario. In this case, Iran's enforcement is limited. International backlash is strong. Most shipping companies actively reroute their vessels. Only a handful of tankers pay the toll, perhaps those with no other choice, or those flagged by allied nations. Traffic through the strait remains at a fraction of its normal level, perhaps less than 10%. Under these conditions, Iran might collect around $1 to $2 billion annually. Second, a moderate scenario. Here, Iran establishes a more consistent enforcement mechanism. Shipping traffic recovers partially. As some companies decide paying the toll is cheaper or less risky than alternatives, Iran offers discounts or exemptions to allies like China, Russia. In this middle ground, around 25 to 40% of normal oil traffic complies. Iran's annual revenue could climb into the range of $5 to $10 billion. In more forceful futures, revenues mount up to 70 or even 80 billion. This monetization strategy, while potentially lucrative, is fraught with immense legal risks, political risks, military risks. And it is a high-stakes gamble that could easily backfire. The first major hurdle is international law. The United Nations Convention on the Law of the Sea, UNCLOS, establishes the right of transit passage through straits used for international navigation. This principle holds that ships should be able to pass through such waterways continuously and expeditiously. Imposing a mandatory toll could be seen by many nations as a direct violation of this long-standing maritime law, inviting legal challenges at international tribunals. Beyond legal objections, Iran would face severe political and economic backlash. The United States and its European allies would almost certainly respond with a new and even harsher wave of sanctions. These could target not only Iran's government, but also any port, shipping company, or financial institution that complies with the toll system. This would create a powerful deterrent, forcing ship owners to choose between paying Iran's toll and being locked out of the Western financial system. The threat of secondary sanctions could effectively cripple the tolling mechanism before it ever gets off the ground, scaring away potential payers. The most dangerous risk is military confrontation. A move to enforce a toll on all shipping could be interpreted as an act of aggression by major naval powers, particularly the United States. This could lead to the formation of an international naval coalition to escort tankers through the strait, directly challenging Iran's authority. Such a standoff would be incredibly tense and could escalate into a direct military conflict. The implementation of a toll system in the Strait of Hormuz would send immediate shockwaves through global markets. The most direct impact would be on the price of oil. The toll itself acts as a new tax on the global oil supply. This cost would not be absorbed by the oil producers or the shipping companies. It would be passed directly on to the final consumers. If it costs an extra $1 per barrel to get oil out of the Persian Gulf, the price of that oil on the global market will rise by $1, plus a premium for the new political risk. The market abhors uncertainty, and a toll system creates a cloud of it. This increase in crude oil prices would quickly translate to higher prices at the pump. Gasoline is refined from crude oil, so its price is directly linked. Diesel is refined from crude oil, so its price is directly linked. On March 31, 2026, as the crisis escalated, average gas prices in the United States had already hit $4 per gallon, a surge of 30%. A permanent toll would lock in these higher prices or push them even further. Households face higher transportation costs and a squeeze on budgets. Businesses face higher transportation costs and a squeeze on budgets. For economies as a whole, it acts as a drag on growth, as consumers and companies spend more on energy and less on other goods and services. Rising energy prices are a primary driver of inflation. When the cost of fuel and transportation goes up, the cost of almost everything else follows. Food becomes more expensive to harvest. Food becomes more expensive to ship. Manufactured goods become more expensive to produce. Manufactured goods become more expensive to deliver. This widespread inflation presents a major challenge for central banks around the world. The European Central Bank has already been forced to postpone planned interest rate cuts and raise its inflation forecasts. If inflation remains stubbornly high, central banks may be forced to keep interest rates higher for longer, increasing the risk of a global recession. The market volatility would extend to stocks. The market volatility would extend to other assets. The threat of a major supply disruption described by the head of the International Energy Agency as the greatest global energy security challenge in history would cause investors to flee from risk. Stock markets would likely fall, particularly in energy-intensive economies in Europe and in Asia. Investors would seek safe haven assets like gold. Investors would seek safe haven assets like government bonds. The situation creates a binary market, one where things are tense but flowing, and another where the flow stops. The constant threat of moving from one state to the other would keep markets on a knife's edge for months or even years. In this high-stakes economic scenario, there would be clear winners and losers across the global economy, and identifying them is key for any investor. The most obvious winners: oil and gas producers outside the Persian Gulf. Companies operating in the United States, Canada, Brazil, Norway. They could sell oil at higher global prices without paying a Hormuz toll. Profit margins would expand. National oil companies in these regions would see massive revenue windfalls. If you liked this video, like, share, and subscribe to the channel for more.